Good afternoon, everyone. First of all, tremendous job by Melanie and Diane in putting that very exciting collage of highlights from last year's AIN Live and Learn held in South Beach, Florida. We're coming to you live from Clearwater Beach, Florida right now, sunny and 82, just in case anybody's wondering. We have a very exciting Live and Learn, virtual Live and Learn March presentation for you today, featuring not only a wonderful partner, but a very close personal friend, founder of Barnes & Associates, Mr. Michael Barnes, as well as a wonderful session on best business practices being conducted by Mr. Mark Osborne on alternative forms of revenue and maximizing RMR via technical sales strategies. So with that ado, I'd like to turn things over to our wonderful friend and our tremendous partner, Mr. Michael Barnes.
Helps to unmute. Hey, thank you very much, Stan. Good afternoon, everybody from sunny St. Louis. Not 82 degrees, Stan, but maybe only about 50, but still better than that cold freeze we had. So again, thanks for having me, everybody. I'm going to need to pull my slides up here. Let's see if I can do that, or there we go. 1 second. We can get started. There we go. Modern technology. I was telling my wife this morning to try to keep the house quiet because I had this important Zoom call today, and she asked me if I wanted a fresh pair of pajamas for the presentation. So luckily, you actually got me in a collared shirt. So again, I'm happy to be here today. We're going to follow the same format that we have in years past. Let's see if I can get this to advance. Okay. Oh, modern technology, you know, right when you need it. Give me 2 seconds here. Let me see if I can get those to boot back up here. Try again. Okay, from the beginning. Okay, so what we're going to do is we're going to cover the typical topics we have in the past, industry growth and kind of performance metrics among players in the space. We'll then switch to talking a little bit about the industry structure and the trends going on. We'll focus on a couple of threats, not doing the full gambit of them like I've done in the years past, but focus on two that I think in particular have kind of increased, or at least our perception is, and I think is shared by the capital that kind of supports the industry's growth. And then we'll pivot to market values. I'm hoping to cover all of that in about 45 minutes, leaving a good solid 15 minutes for Q&A. So we'll just launch right into it. So the first thing we'll talk about, whoops, it's got to go the right way, huh? Okay, I'm confused. Oh, there we go. Okay. So the first thing we'll talk about is revenue and growth metrics. So how did the industry do back into 2020 and where we are right now? We can talk about, whoops, there we go. Another poor attempt at COVID humor. So obviously COVID impacted the industry a lot in 2020. We're not going to be able to today to dig into the results kind of on a granular level because we're still tabulating our data. It's been very hard to collect it this year. A lot of people are slow in submitting their information. And there's a few things we're kind of scratching our head at. We're not sure we fully understand the implications. But I think broadly speaking, what you're going to see here is that preliminarily in 2020, it looks like industry revenues will be down about $1 billion, from 64 billion down to 63 billion. That's roughly about a 1 to 2% decline. So what's going to happen is it's going to look a lot like it did back in 2009 as we moved into the Great Recession. Basically, sales and installation revenue shrunk. We show right now preliminary from 33 billion down to 31 billion, which is about a 5% decrease. That may actually go up a little bit. We're not sure. Again, we still have a few people that owe us their data for the year, but basically sales and installation revenue down about 5%. We're not sure that that means units installed went down by that much. We're trying to measure that to give a better sense for where the growth is going. But the good news is, if there is some good news, and industry revenue shrinking is that RMR actually moved up 2%. And again, this is the good thing about this industry. And again, similar to what happened back during the Great Recession, that while sales and installation activity shrank, which you can see in 2020, it shrank back to about the same level it was in 2017 or 2018. While that's disappointing and unfortunate, considering the economy shut down basically the second quarter, it still is a very good result, but it's more than enough sales and installation activity to replace the industry's attrition. So we ended up still having some RMR growth, probably about 2% for the year. So again, that is really nice because it is a continuation of basically the 30 some years that we've been tracking industry data. We haven't had a year yet where the RMR didn't increase. So again, that bodes very well for the industry. In terms of segment growth, I'm using a chart that I showed you in 2019. This is still, it's not necessarily to scale, but it's meant to give you a little bit of a sense for where the growth is occurring and what's going on. Generally speaking, we saw particularly towards the latter half of 2020 and moving into 2021, that larger commercial activity was picking up significantly. And you remember back in 2019, early 2020, when we moved into COVID and the quarantining, that segment was really booming, probably growing in excess of 10%, depending on where you kind of draw the line is what constitutes large commercial. But again, very strong demand. It was very nice to see that with a shift towards people not being in commercial buildings as much, or if they are under quarantining restrictions and whatnot, that a lot of the industry's technology was used in order to help monitor that and kind of maintain better awareness and intelligence as to what's going on the premises. So that was good. We also see down then at the bottom of the kind of size and complexity of the system scale that the DIY channel also did very, very well. I think the pandemic was probably perfect for them, at least for selected players. The numbers are up in excess of 20%, I'm sure, in 2020. There's indications that some players actually had record years during that time as everybody moved to go home. And as typical with the industry, when there's kind of a generalized threat and people don't feel safe, when it comes to their homes, they want to kind of cocoon and fortress. So they want to protect themselves. And so we saw a lot of DIY systems growing as well. The middle of the market, which is still by far the largest segment of the industry, is the traditional residential and SMB segment, slowed considerably. Again, going into the pandemic, we were running probably only about a 2% growth rate in that segment, while I think as we went into to COVID, it probably slowed even more. It's highly possible that that part of the segment of the industry hasn't grown much at all in 2020, although we're seeing a resurgence of strong demand. People are now shifting back towards wanting more professional service, and the appearance is possibly willing to pay a little bit more in order to get that. So these are kind of indications as to where we think the segments of the industry are growing the most. The good news is that the fundamentals for the industry remain very, very strong. As we've talked about before, alarm systems work. The technology is getting better and improving at lower costs. It's also broadening the market. There's a lot more things you can do for customers than you could in the past. Penetration rates remain relatively low, although we saw Parks Associates came out recently saying that the residential segment for professional monitoring at least is up possibly as high as 30%, which is a nice gain over the last 5 years or so. There's still plenty of room there for the industry to continue to grow. On the commercial side, while penetration rates are higher in terms of monitored systems, there's still plenty of room to upgrade to new technologies and new applications. The other thing we really like about the industry is it's definitely getting much more sophisticated with improved marketing. And that helps a lot. So the industry is getting its word out there a little bit better and making its use case, if you will. And last but not least, of course, the industry remains of interest to a wide audience, which is necessary because we not only need the end users to be supporting the industry and its growth, but we also need suppliers, manufacturers, and all of the other pieces that go in behind that to remain of interest, and most notably the capital markets, because you can't grow this industry without access to capital, which we'll talk about a little bit later. When it comes to key operating metrics, when you look at all security alarm companies kind of rolled up together and say, so is the industry doing better or doing worse? Going into the pandemic, not surprisingly, there was a lot of concern that the average player wouldn't be able to dismantle costs due to the deceleration in growth, if not the cessation of growth. And also, I guess the biggest concern was that attrition rates would go up. Great news is we've looked at, I think, enough people in the industry, including many of the biggest players and hundreds of the smaller players, that we've seen no material movement in attrition. Now, that doesn't mean that some people haven't experienced higher attrition. It appears from what we can see, it depends on who your customer base is. If they were fragile from a number of different perspectives, then obviously COVID and the pandemic and the economic response could have caused higher attrition, and we do see a number of companies that have experienced higher. But surprisingly, there's also almost as many companies that actually lowered their attrition or remained flat during the year. So overall, and that includes ADT, by the way, actually brought their attrition rate down slightly. So basically, we're calling the year flat on attrition, and that is great news. Now, hopefully embedded in companies, and we've been trying to survey around this and look a little deeper with the clients that we're doing projects with, asking the question, are you sure you don't have kind of a buildup of dead wood in the wood pile? I mean, that would be customers that are way behind on payment or are just, on the verge of canceling, but you're kind of hanging on to them or giving them a break while we get through and get the economy fired back up. Generally speaking, we're not seeing that. There might be a little bit of that. And with an increase in moving activity, it's possible that we might see attrition rates move up in 2021. But again, knock on wood, so far, we're not seeing it. So that's definitely the good news. Unfortunately, there's a little bit of bad news in 2020. Some of it's not unexpected. So when you look at the three kind of key metrics that define an alarm company's ability to preserve value and generate value, you're looking at, number one, the cost to originate new customers and their recurring revenues. Number two, what kind of margin do you make on the recurring revenues while you have them? And number three, of course, how long do you get to keep the average customer, which would be embedded in the attrition rates. Well, again, as we said, the good news, one of those metrics in 2020 is certainly, it's good that it hasn't moved up, and that's attrition. The problem is, while we're still tabulating 2020's results, the near-term indications are that average performance actually declined on the other two. That is that the creation costs for new customers in RMR went up, and that the margins on average yielded on those recurring and related revenues went down. So let's talk about the first one, which is creation costs having gone up. That in and of itself isn't that surprising, because what typically happens, and we saw this back during the recession as well, is when alarm companies contract their sales and installation activity, in other words, do less of it, then the G&A that supports that activity gets spread over a smaller amount. So use a good example. If you were originating $1 of RMR at, let's say, a 20 multiple, just to make the numbers easy, and your G&A put another 10 turns of cost load on that, so your all-in fully burdened cost was 30 times every $1 of RMR that you originated. Well, the second you cut your origination activity by a third, unless you reduce the associated G&A by a third, all of a sudden you're going to move up in terms of the creation cost. So we were expecting a little bit of that going into the pandemic, and it looks like it's definitely come true. But the problem with it is that it's not clear to us that it's all associated with the reduction in volume. It looks like, as had been the case moving into 2020, that the industry's wrestling with kind of competitive price pressure. That is that pricing has gotten generally to where it's hard to originate $1 of RMR at lower costs than you have in the past. And so we're not sure where that's going to go, but that doesn't bode well for the industry. And again, this is all relative. Might do a quick little aside. When you think about those three variables, cost to originate, margin that you make while you have the customer, and how long do you get to keep them? Remember, it's all three of those. So if you look at like the PERS space, where creation costs, or let's just say margins are very high, but attrition is very high, for instance, well, that's offset by higher margins and lower creation costs. When you get into the commercial market segments, for instance, you see lower margins on average because of a lot of maintenance contract and activity, intense activities supporting the recurring revenue. Well, that's offset by generally low attrition and higher and lower creation costs. So it's really a 3-variable equation. The point I'm trying to make is that it's okay, the industry can kind of improve its overall economics with a higher creation cost, only if it moves the margin higher or attrition rates down. Well, generally, as we discussed, I don't think attrition rates are likely to come down much further in the near term. I think most of the big correction has happened. And if anything, moving into 2021, I think we're likely to see attrition move up a little bit with all the moving activity and other stuff kind of built up. The problem is that the net margin is declining. And that's the one that makes me, and I think a lot of capital that looks at the industry, very nervous, because the general thinking is that the narrative that you typically hear is when it comes to providing the recurring services underneath the recurring revenue, it's an economies of scale model, right? I mean, bigger central station, bigger customer base. I should be able to route more efficiently. I should be able to monitor more efficiently. And so we should be seeing margins getting better. But the reality is they're not. We've been now probably for about 10 years having a consistent slow decline in that margin. And the reason is, even though the industry's gotten bigger and a little bit more efficient, the reason is because we're now selling a lot more than just monitoring or simple maintenance. There's a lot of other services that are embedded in RMR and the associated revenues. And those are being priced at a level where it doesn't come in incrementally at the same margin. It actually comes in a little bit lower. One you might think about is the interactive services piece in the residential market. You know, if it costs you $6 to get that interactive service, if it was going to be accretive to the margin, that is, come in at a higher one, you would have to add on more than $12, $13. In other words, you'd have to double it for that incremental additional to yield a 50-some% plus margin. And most times the market doesn't let you do that in terms of pricing. But this is a problem that the industry has to get its hands on. And the reason for that is because it's important that, you know, if you're going to keep growing in this business and keep all of your capital at risk in the business and entice other capital to come in and invest in the industry, then you have to have unit economics. You have to have the ability to demonstrate that I can grow the business in a way that improves the value of the company. The problem is at these metrics, with them trending in the direction, we're getting very, very close to where the kind of the unit economics of growth does nothing other than provide a return that's about the same as the cost of capital. So what that generally means is that if you tried to get investor capital and bank debt in to fund your growth, if all you can do is create value that gives them a return appropriate to them taking risk, but is nothing in it for you, then, you know, there's a question as to whether or not that makes sense. And I think a lot of people are kind of rethinking their pricing model. And I would tell you, this is a good time to do it. I think as the economy opens back up, I think there's been a bit of a reset with end users. They understand that the service is essential, that it's important, that it provides valuable services. And I think it's time for some price increasing, certainly on the sales and installation side, if you can. I think it's very important. What's also interesting in terms of metrics, and I'm not sure whether this is good or bad news. We can talk about it a little bit, or I'll frame both sides of the argument as to whether it's good or bad. But we have kind of an unusual event in that 3 of the biggest players, at least some of the most notable players in the space, actually are improving their metrics in 2020. So here we have a recession, pandemic, lockdown in the economy, big disruption and whatnot. And these 3 players in particular had very, very good results in 2020. ADT in particular did well, considering it's ADT. I mean, when you think about how big they are, or their kind of checkered past in terms of operating results, it was nice to see that in 2020, they increased revenue 4%. They increased their RMR 2%. They increased, this was interesting, they increased the additions, the amount of new RMR they originated in 2020 internally, not through acquisition, versus the year 2019, they were up 3%, which is impressive. They also lowered their creation costs and lowered their attrition by 30 basis points. But like everybody else in the industry, they had lower margins. So interesting year for them. Overall, a good year. Plus, you got us from ADT's perspective, we'll talk about this a little bit more later. They got a $450 million investment from Google. Not a bad year for ADT. Vivint, in many ways, did even better. They increased revenue by 9% in 2020. They increased RMR by 4%. And unit additions In other words, the amount of new customers they created in the year was higher in 2020 than in 2019, and they lowered their attrition. We're still looking at them now that they're a public company, not fully through with the results yet. And last but not least, on the DIY side, with SimpliSafe, it's our understanding, even though they're a private company, that they had one of the best years ever. Again, I think the pandemic was made for DIY offerings. SimpliSafe has kind of moved in to take more market share, given a lot of the other players are stumbling around a little bit or losing access to capital. So 3 great players, ADT now big in the commercial market segment. I think if we get the results from Johnson Controls, Tyco for their commercial activities for 2020, I actually think we'll see the numbers be relatively decent as well. So again, the good news is this speaks well for the industry, and this is kind of the, if you will, the public or investor or capital market face of the industry, because people can see these companies. It bodes well. It speaks highly to how resilient the industry is, and how it can be a good place to invest your dollars. The potential bad news, though, is we're reading this as these 3 players in particular, and some of the other larger players, are getting much more competitive. You know, it used to be that you could count on ADT to stumble around a bit. They weren't that good in customer service. They seem to be big only because of their long history or growing through acquisition and whatnot. That's kind of changed. They seem to be much leaner and meaner as a competitor, and certainly with Google as a partner now, might be a little bit frightening. Vivint, same thing. I mean, they made a great pivot, not away from the door-to-door sales model, but certainly adding their online presence and how they're originating customers. And then of course, SimpliSafe has done amazingly well on the DIY. So I think the bad news is these guys are probably much tougher competitors than they were in the past. It's possible it may signal that being bigger is better. That's one of the threats we've talked about in the past. I'm still formulating our opinion on it. At this point, I'm still very bullish on small and medium-sized companies that operate well and are deeply entrenched in their market and have strong capabilities. But I think we need to keep an eye on whether or not it's possible that just simply being larger gives a competitive advantage. So when we talk about operating metrics, I'm just going to throw the screen up for a minute. We're not going to go through the details, but I wanted to tell you that it's very, very important as you try to improve your metrics, which I think is a must. We need the whole overall industry to improve in 2021 across the 3 critical metrics: the attrition rate, the margin on monitoring and service revenue, and the creation cost. I wanted to throw up this example company again and just show you how those are calculated. You'll see down below, just a quick note, that's the combined P&L down there on the left. To the right, we've split it into the 2 activities, which would be monitoring and service, or the recurring and associated billable service revenues and its costs, including absorbing 50% of the G&A, and then sales and installation isolated with all of that cost, including half of the G&A as well. So this is how the metrics are calculated. It's done on a net operating cash flow basis. You do not want to do this ignoring costs that have been capitalized, for instance. This is really a cash on cash analysis. What I'd like to remind you of, I think all of you know Spencer Rogers on my team. He is a wizard at this. He can help you get to those numbers. Please, by all means, reach out to him. Stan and the AIN team have us available to help you guys in calculating these numbers and interpreting their results. So very, very important. Reach out to Spencer if you need help. So let's shift to the industry structure and players and see if any of that is changing. So as we've talked about before, the industry is still pretty well fragmented. These numbers are still moving around a little bit for the end of 2020. I don't think we're going to see any major adjustments, but broadly speaking, the national players, of which a list of most of them are off to the right there, have about a 42 or 43% share of RMR in the industry. You then have regional players, which takes you down pretty much through the SDM 100, maybe a little bit below that, have about a 12% market share. And then you have these thousands and thousands of smaller companies. The estimate is still possibly upwards of 6,000 or 8,000 small local companies that still hang on to about 38% share of the industry's RMR. There's also this emergence of other, and other is a little bit more specialized players, folks that are clearly security alarm companies, but there are also a lot of other things. The perfect example is the company that used to be called Electric Guard Dog. is now called Amrock, I believe is the new name that they have. But they do electrified fencing around areas that need high security, perimeter security, and also then integrate that into an alarm system, which is interesting. So we put a lot of those specialized players, some of the pure video players that are a little bit outside the mainstream, put them into the other, and they're upwards of a 7% market share. So if you look at how that's changed over time, this next slide shows the color coding in the same way. So we see the blue bar are the national players, the red bar is regional. You have this other specialized player in gray, and then you have the green being the thousands of smaller local players. What we've definitely seen is a continuation over the last 10 years of kind of a consolidation. That is the bigger players taking more market share, particularly the big national players. And I think 2020 will bear that out as well. Probably they'll have picked up a little bit more. So I think this trend continues, but I don't think I don't know how to say it. I think it's inevitable that the industry will get fewer overall players, but I don't think it means the end of the small, highly capable, localized player. I think there's still some that are very strong. There's market segments that they are just almost unbeatable in. Some of them have great brand names, having been around for a long time and whatnot. But generally speaking, I think this trend is likely to continue. One of the reasons is linked to that performance metric issue we were talking about before. The overall industry's average performance metrics get better if everybody all of a sudden operated more at scale. In other words, you eliminated a lot of the very small players that carry a lot of relative G&A. They have relatively low margins on the monitoring and service. Luckily, so far, they're offset to a degree by low attrition and lower creation costs. But generally speaking, I think you're going to see the industry move towards fewer players. So more of the customers, more of the industry's assets and operating infrastructure is operating more optimally, if you will. So I think that's part of the consolidation. As we're going to talk about too, the capital markets are going to push this, because I think that the days of access to capital are going to get harder and harder for players, and which we'll talk about in a little bit, but that's going to also promote continued trend towards consolidation. But again, nothing earth shaking. I mean, I don't think, we're going to get back together next year, even 5 years from now, and this chart will have materially changed, other than I do believe that the bigger companies will have a higher share. One of the other things that's kind of moving things along a little bit, we're noticing, and we saw this actually at the end of 19, Sales and Security, or Security Sales and Integration magazine put this chart out that shows that back in 2015, 47% of their readership, the owners of the companies, were more than 20 years old. In 2019, that was up to 53%. Presumably that's gone up again. So what happens at 20 years, plus or minus, is the companies get bigger, plus you start to get into multi-generational issues. And I think there's a lot of times people that founded their company, in their 30s or 40s, start to rethink whether or not it's time to maybe exit the industry and, pad the retirement account with something a little bit less risky, if you will, or at least a concentrated investment in one company. So I think that's fueling the consolidation as well. So now we're going to switch to threats. And so normally, if you remember, I tend to talk about 7 that we kind of keep our eye on. Things like, is the opportunity of the industry tapped out? Is bigger better? Is that dynamic changing? A number of those. But given the time we have today, and I'm still rethinking on some of these threats, I thought the better use of the time would be to focus on two that we, in particular, we think are moving, if potentially more aggressively. So determine or warrant kind of a little bit more of a focused look. So the first one is this question about technology exclusivity. So the argument is, or the threat is that, the industry wakes up one day to the fact that ADT or Johnson Controls or somebody big, presumably, or a new tech player comes in and has some killer app or some ability that you just simply can't match, that you can't get access to the technology, that they've developed something in terms of hardware or software or something, artificial intelligence or something like that, that really, really is a compelling offering. You see the end user market very, very interested in it, but all of a sudden you can't get access to it. So pretend, for instance, that doorbell cameras, I mean, I know this is a bad example because it's such a narrow application, but pretend, for instance, that doorbell cameras came out, that Ring was the first one to bring it out, had some massive proprietary technology and scale and patents that basically made it to where nobody else could offer a doorbell camera. Well, then I think, what would happen is that segment of the market would default to them, obviously. I mean, there's a lot of consumer demand for it. And if there was only one provider, then that would be the case. Historically, the way it's worked in the industry is that somebody will come out with something new, like doorbell camera, and it takes a little while, but industry manufacturers and others quickly match the capability. They're big. They produce the product at scale at a decent price point, and all of a sudden you have access to it and you can offer it. So that's the way it's historically gone. I guess the risk is of waking up one day and finding out that on something much more material or fundamental to the industry, one of these big players has some exclusivity and difficulty. I think the risk in this channel is actually going up. We used to put this down as a relatively low level, but there's a couple of things that we're starting to notice. First of all, you can't ignore the fact that innovation is just generally increasing, the speed of it. So every year, things move forward another notch. So it's one more opportunity for somebody to come up with something, very unique or creative. The other thing we're noticing is that when you look at like the three players we talked about earlier, ADT, Vivint, and SimpliSafe, that all three of them, particularly with ADT's $450 million investment from Google, which our understanding is targeted towards taking some of their products, the hardware and the software behind it, and coming up with proprietary platforms and proprietary capability. There's a little bit of a concern that maybe the industry suppliers won't keep pace in terms of matching that innovation quickly, if not actually leading it would be even better. And so it's important to keep our eye on this. I don't think it's anything other than maybe in the yellow level at this point. I could see it going back down, but it'd be nice to see a good, strong surge by industry suppliers to make sure all of you have access to the best technology. And by the way, again, kudos and my hat's off to all of you as part of the AIN group, because I think that's one of the key things that AIN brings you is a great communication pathway with your suppliers, access to big technology, good dialogue, a good ability to articulate what you need in order to be most effective and to get it quickly and to get it competitively. But that's one of the risks that I think we definitely have an increase and we need to keep our eye on. The second one is kind of in the background, but it is important for a couple of different reasons, and that is capital shortage. I mean, what's happened, and this is the one that I think is more critical right at the moment. It's not to say that we can't overcome it, but the way I'm viewing this is for our clients, which are, those of you that are on this call and other, medium-sized to large, medium-sized, even some smaller security alarm companies who we work with. It's important to be able to get you capital, because as long as it costs money to originate $1 of RMR, that pricing model stays, which is basically security as a service kind of as the model. I mean, that's going to require continued capital. And the other thing is if the bigger guys are growing, in order to keep them from taking market share, you have to match their growth rate. And you have to have good equipment, and you have to have all of the pieces of the puzzle in place. Well, if we can't raise you capital, then you're going to have a hard time growing any faster than just what your free cash flow comes from off of your embedded base. And again, being a little bit smaller, you might be a little less efficient than ADT in that sense. And most companies, if you literally had zero access to any capital, probably have a growth rate, depending on your metrics, that caps at about 3, 4, 5% a year is all you can fund out of the free cash flow coming from your existing customer base. You can replace attrition and then grow your base by about that rate before you need some outside capital, be it debt capital or whatnot. So the biggest interruption we've had in the capital markets is on the lending side. I think as most of you are aware, Pacific Western Bank, Bank of America, and NXT Capital in a very formal basis and somewhat noisily withdrew from supporting the industry. It didn't all have to do with their lack of confidence in the industry. A lot of it had to do with, although all three of them actually had some bad loans on the books. But if you look back, by the way, those bad loans, that was the bank getting over their skis. They just simply lent the company too much money. Now, ultimately, the responsibility is with the borrower, right? I mean, they shouldn't have borrowed that much money, but they hit problems. They ran into roadblocks. They stumbled on their performance, and they weren't able to service the debt. And these three banks just decided we're no longer going to support the industry. They also had some regulatory pressure because, as we've talked about before, understanding security alarm companies and how they create value is, there's a little bit of a trick to it, right? It's not as obvious. You can't pick up the average alarm company's income statement and see this huge profitability and go, oh, well, that's why somebody would buy them for $5 million or $10 million. No, you usually can't see that. The reason somebody would buy them for 5 to 10 million is because, as we saw earlier in that example, there's huge margins and free cash coming from the existing customer base and the ongoing services. But it takes capital in order to replace that attrition and actually grow the base. So depending on your accounting treatment. So anyway, we have the debt markets no longer supporting. What's come with that? Well, there are some that are, but generally there's a huge conservatism that's kind of come in on the debt market. So if you're looking to borrow, you're going to find it much harder to do it these days. And it's going to be much more expensive generally, but it is out there. But it's also, because of that, it's caused private equity investors to sit a little bit on the sidelines, because they're all of a sudden saying, I don't want to move into an industry where I want high growth to get my returns, and I can't get the debt to support that. And oh, by the way, what are these banks afraid of? And then they'll hear this narrative that, well, the industry is about to get disrupted by big tech players, that there's all this DIY is going to come in and clean everybody's clock. I mean, there's all this kind of horror story narrative out there in the industry, none of which we think is mostly overblown. But generally, that's put a lot of money on the sidelines. That also has then dropped support for the acquisition side of the market. So you see values coming down generally, and that spooks everybody. It's kind of a self-feeding cycle. Much as it feeds itself going up, values go up, performance goes up, industry's doing well, more capital comes in. It's kind of a self-feeding cycle, where you can have the reverse of that as well. And that's kind of where we're at right now. This is a real problem, because if the industry doesn't support anybody other than the largest players, people like ADT, who can get Google to put $450 million into them, then that's going to be a problem. It means the bigger players will, again, grow faster. They might gain additional competitiveness through scale or through access to technology, and it could end up being a problem for smaller players. So this is potentially a very big deal. One of the steps we've taken in order to beef up our ability to help you is we recently hired Joe Thompson. So Joe Thompson, many of you will recognize, has over 20 years history lending to the industry. He was with SLP Capital back in the day, then with Capital Source, and Capital Source was originally eventually bought by Pacific Western Bank, one of them that just got out. And he ran that division most recently, and he threw his hands up and said, the bank is making a bad mistake here. I need to go help develop new lenders for the industry. I need to help capable alarm companies get their hands on debt capital. So he elected to do that with us, which is great. Perfect platform for him to do that. So feel free to reach out to Joe if you're looking for additional bank debt or investor capital. So where are we on market values? Given that capital's a good place to segue into market values. So generally speaking, when you think about the market, you have, as we've talked about before, you have four forces that kind of affect where values are and how many deals are getting done. So you have to have buyers and sellers, of course. If there's a mismatch in terms of the number of buyers versus the number of sellers, in other words, say, for instance, there's lower demand, then prices will tend to go down. If there's a scarcity of sellers, then prices will tend to go up. Obviously, affecting all of that, or intermixed with that, though, are the metrics. How well is the industry doing? How well is the average company doing? Will determine a lot about how values kind of play out. And then last but not least, no matter what buyers and sellers may agree on in terms of value or the metrics the industry might fundamentally support, you have to have the capital. If the capital is very expensive, then values have to go down. If capital is real cheap, then values tend to go up. So where we sit today is pretty much where we sat at the end of 19. This is definitely where we are here in February of 2020. The market is still very bullish generally. There are exceptions, but overall speaking, values are down, they're moving down, and there tends to be kind of a negative sentiment around values. basically reflecting the perception that there's higher risk in the industry, there's less capital available, and the capital that's available is more expensive, and concern that the metrics might continue to kind of degrade a little bit. So market's off about 10 to 20% from its highs. Yeah, hard to peg that, but if you looked at an average super performer that maybe was worth 40 or 45 times the RMR, it's probably worth something like 10% less than that now. So think, 36 to maybe 40, generally speaking. There are a lot of cases where values are quite a bit lower, which we'll talk about in a minute. There is some indication that the market's stabilizing a little bit. We are seeing what typically happens is kind of the market gets disrupted in larger deals where you see capital and buyers react most notably very quickly. That starts to filter down to smaller deals. But as prices start to move down or values move down, inevitably you have kind of the larger regional players willing to step in, or some knowledgeable local investors and whatnot. You have a number of parties that kind of get it and understand the industry. So when values drop, they continue to fall, and then all of a sudden you see them kind of stabilize at a new level as these kind of knowledgeable buyers step in and kind of stabilize the market. That's pretty much where we're at today, we think. The bid-ask spread is still very high, though. It's tough to get a deal done. Inevitably, when you sit down, I mean, we did two big deals in 2020, and they were tough. They were very, very tough. When you sit down, what the seller expects versus what the buyers are offering, huge spread. So it's very hard to get reconciliation around that and actually get any deals done. In 2020, though, while the market was very slow, as you would expect, kind of hard to think about doing a deal, certainly in the second quarter. Things rebounded a little bit in third and fourth quarter. A lot of buyers sensing some opportunity, getting comfort that they can do due diligence remotely or with minimal amount of need to travel or get around to the company, and people settling in on being able to manage from home and remotely and through Zoom and things of that nature. So we're starting to see the deal activity pick up a little bit. Selected larger deals that did get done, most recently would be Select Security, which we handled. That was a regional consolidation play that was right in the middle of trying to beef up. It bought in a lot of different markets, didn't have real concentration in many of them, and was needed to keep going, but kind of had a business plan interruptus in that it defaulted on its debt and it stumbled a little bit right at a time when it was hard to get any support for the additional capital that they needed. They elected to sell. The best bid was surprisingly Brinks in a highly structured deal, which we could talk about if anybody had questions around that. You see Ackerman, who sold about half of its customer base and now switched to becoming a dealer for ADT. We saw Front Point recapitalize. We saw Protect America also bought by Brinks. And then we saw F.E. Moran transact with Securitas. What's interesting is that when you look at these deals, this grouping of them, there were other deals that were done, a number of smaller deals in particular at respectable values. But when you look at this, it's really like the tale of two deals. You can see what was liked and what wasn't liked. So, for instance, in the Protect America and Select Security, there were problems because it was residential. Well, Select wasn't. Let me skip that. I'll come back to talking about the two contrasts of the two deals. But generally, what the market likes right now is good explainable results. And this is another interesting thing for any of you that might be thinking about bringing your business to the market or raising capital. You have to be able to explain the results. The burden of proof is on you to explain them and to do it in a compelling way that ties to the numbers and helps somebody understand what's going on. So if you've stumbled in a few places, you have to have the data that documents that. The market also tends to like commercial-oriented operators at this point. There's a perception that there's lots of opportunity there and that the economics are a little bit better. It tends to like geographic or vertical market focus, much better than if you're sprawled all over the place to be a really strong player in a tight geographic area or within a certain vertical market. And to have a professional culture and be well documented. This is important because obviously if you were to sell to a larger player, be it Securitas, Johnson Controls, ADT, somebody, Vector, somebody of that ilk, it's important that they feel they can assimilate the company. And so your culture is very, very important. And those that have professional cultures and are well documented tend to trade better. Here's what the market doesn't like. The market definitely does not like residential mass marketing focus generally. Now, what's interesting is Simply Safe, for instance, is getting huge valuations and huge amounts of interest. And anybody that can go toe to toe with them with big money, neat, primarily proprietary technology, great online capabilities and fulfillment capabilities, that is actually of interest. But if you're kind of a Protect America or Front Point, even though you're big and have a lot of experience in the industry, there wasn't that much interest in supporting either of those deals, and they both got relatively low valuations. If you're not consolidated, the industry definitely does not like that, and that was Select Security's problem. It was a neat company heading towards potentially being a great company, but unfortunately, it was just kind of a mile wide and an inch deep in many markets. It didn't have that kind of scale and coherence and consolidation and infrastructure build out in all the markets. It was originally just kind of buying to establish the footprint, and then had planned on backfilling in all those markets, but unfortunately got interrupted with some problems with the company, and then the capital markets not supporting them. Definitely old installed technology. I mean, get out there and get your radios upgraded. Then that's just the small thing. I mean, if you have a lot of old equipment out there that's hard to service, hard to get parts for and whatnot, or you don't have kind of a machine for which informs customers of all the new technology and gets them upgraded, that's definitely a negative in companies that are out there. Poorly documented results, big time problem. You got to have that. And overall, if you have broad-based poor performance, make this one comment: you can do well and get a good value in a company, just as many of you that are buying companies can see the value in a company, provided if there's poor performance, it's understandable, it's explained, people understand what's going on. So the last thing we'll look at before a couple of closing comments is on valuation is the ADT as kind of the bellwether valuation. Here's a picture of how their stock traded through 2020. As you can see, the stock was moving down to the end of Q1 2020, generally out of concerns where ADT was going and their competitiveness and things of that nature. And the industry, we saw values moving down. And then COVID hit and the quarantine hit. And I think people quickly recognize that a good place to invest is in companies that have high recurring revenues. And that was ADT. So we saw the stock start to move up in about August, September. Google made their investment, the stock spiked, and where we see it trading today is roughly at about 44 or 45 times its RMR. And this is something to keep in mind because this is the bellwether value. With ADT, the largest, arguably should be one of the most competitive players. Now they're back into both commercial and residential market segments. They're improving their operating results. They have Google as a partner, and they're trading at 44 times RMR. So that's kind of what you're up against if you're looking to sell your business. Probable trends in 2021. This will be the last slide, and we can shift to Q&A. Stabilizing the values. We're already kind of seeing that. More deals getting done. We're seeing a pickup in the market. The bid ask is getting reconciled. It's at lower values, but still very respectable values. Very, very slow transaction cycle times. If you're going to try to do anything to buy somebody or sell your business or raise capital, expect it to take twice as long as you thought it should. It's tough to get through it. There's much more higher burden of proof, as we talked about. If you're going to raise capital or sell the business, the seller has to be the one that can defend the valuation thesis. Here is why I am worth this much money. It's very, very important. You can't just put your business up and expect the buy side to automatically gravitate towards a high valuation. A lot more structuring of transactions. We're going to see more seller financing, earn-out related deals and things of that nature. And last but not least, I think we're going to see mergers come back as a deal structure where two companies will get together and say, hey, we both have, not very efficient on the monitoring side. We both have a little bit more G&A than we need, things of that nature. If we combined, we could be bigger and much more efficient. Why don't we do that? As we see more companies and more operating infrastructure trying to get more optimal results, which is needed. And again, reach out to us. We're here to help you on that. That raising capital and M&A is my specialty and my partner's specialty, Mark Gronowski. Always here to help. Would love to hear from you. And I think that's it. And moving into the Q&A now, I see Melanie pop back up, so she's probably got a couple of questions.
Yeah, so if you have any questions for Michael, please type that into the Q&A or in the chat.
Can I ask, I'll do the first question. Can I ask a live question? Can you put me on?
Stan has the first question.
Hey, Stan.
Michael, in response to your question to me, as it relates, and I want everyone to hear this. This is from one of my closest friends in the business, Moneybags Michael Barnes. Stan, as much as I like Eye of the Tiger by a great band, Survivor, wouldn't you think it would be more appropriate to play Burning Down Your House by the Talking Heads? This is the type of respect I get from this guy. I get no respect, all right? Thank you
Hey.
so much. We love you, Michael. All right.
Thank
back to
you, Stan.
Melanie.
Thank you, Stan. I meant no disrespect.
Okay, are
You-
there any questions?
That was simply because I'm jealous, Stan. You know that.
I don't see any at this time. We'll give it just one more second, see if there are any more. Oh, I got a question. Hang on one second.
Okay.
Michael, what percentage of sale price do you see being seller notes or seller earnouts versus bank notes and buyer cash?
Yeah. So, we're seeing this come up more and more. So generally speaking, the math roughly works like this. If the seller note is going to be truly a debt instrument, then it still can't be any bigger than what the debt markets will generally allow an alarm company to have in terms of total indebtedness. So here, I'll give you an example. Say, for instance, somebody's borrowing from still one of the club lenders. They've kind of marked them down and said, we were lending to you at 20 or 24 times. We're now more comfortable lending to you at 18 times. There's still, even the bank is probably saying to the alarm company, at 18 times, we still don't want you to have too much debt above that. So maybe 24, 26 times. So if you see somebody buying a company for 30 times, what they might say is, I still want to get 26 times debt on that. The bank will only give me 18, which means that you'd probably have something, like 8 to 10 turns in a seller note. I mean, that would be probably the lower end of the scale. So if the deal was paid, you're paying 35 times, or let's say 36 times, that means something like 25 or 30% of the deal would be financed with a seller note. But that, it doesn't have to be that way. I mean, in some cases, I could see buyers saying, I need you to finance much higher percentage of that. And then trying to tell the seller, but I can give you like equity, preferred stock or something that looks a little bit like debt. Maybe some shares of the common stock as well, something, but basically requiring the seller to finance, a much higher percentage of the deal. But generally speaking, I still don't see, overall debt for alarm companies being much higher than, that mid 20s, maybe 30 times the RMR. If anybody's looking at a deal like that, though, I mean, by all means, give us a call, because I'm happy to just get on the phone and chat about it and help you kind of triangulate as to where that financing structure might fit and what would work best for you. Because again, if I can make one more comment, I think I mentioned to you that several of the banks that had been lending to the industry got out because they had some problematic loans. And when you go look at the situation, what you find out is the bank simply lent the alarm company too much compared to the volatility potential of their performance. The time they lent them the money, the company was performing just fine to service it. But then what happened is something changed. And that's, if you look back historically with many of these borrowers, you see fluctuations in attrition or G&A levels or other things such that they should have never borrowed that much money because they were going to trip some covenants, because they have natural volatility in their results that could cause that to happen. So the point I'm making is that just because somebody's willing to lend you the money, as I said earlier, doesn't mean you should borrow it. So be careful. I mean, I think seller financing makes a lot of sense, but it's very, very important that you structure it right so that you don't end up defaulting with the seller as well.
Okay, I have someone asking, a lot of your graphs showed 2019 versus 2020. Can you just speak to that?
Yes. First of all, my apologies. So this has been one of the most frustrating years for us in over 30 years of being in this space in terms of tabulating data and collecting it and making sure we understand it and can verify it before we put it down into slides. So normally we have a very natural kind of wall that we hit in getting all of that done with our annual conference, the Barnes-Buchanan Conference, which is held in February. And so usually when I come to speak to you guys, we've had the Barnes Buchanan conference and we have all of that data kind of tabulated. This year, for the first time in 25 years, we canceled the conference, which was very, very unfortunate. But in hindsight, and I even called Stan and I said, Stan, you got to put me on, like in March, because I'm not sure we're going to be ready with all of our data. And the reality is it's good we canceled the conference in many ways. And unfortunately, with this presentation, we just simply don't have it all collected yet. So I tried to use some of the 19 data and give you a little bit of color around what we're seeing around 2020, but we don't have it done. Here's what we do plan to do, though. We're still planning on getting the full detailed deck and briefing that you're used to, and then some. Actually, we're planning on getting all of that done still. It's probably going to be now more like April, unfortunately, before we do get it done. We're going to do a series of videotapes, like 20-minute segments on it, maybe 3 or 4 20-minute segments, videos, which we're then going to make available. So keep your eye out. All of you are on the list to get access to that material. So when it's done, you'll have the slides with all the 2020 data in there and a good narrative to go along with it.
Okay, I don't want to look at.
Okay, last question. Are there any certain segments in commercial that bring a higher value, i.e. security, access management, video monitoring?
Yes, yes, and yes. Those are so any of them, I mean, what we're finding in the commercial market segment on value is it's kind of interesting. So anything that is good, fundamental, block and tackle, intrusion, fire, access control stuff that the industry's done for a long time with good customers, priced really well. And if you're a company that's had long relationships with these companies and you got very skilled technicians in those areas, that is still very, very valuable. It's good block and tackle capability. There's a lot of buyers that are very, very interested in that, from regional players up to the big national players, and even depending on your size and capability, from private equity. Where we're seeing some of the most extraordinary valuations, though, is in the video space. But you have to be particularly good at it. You have to have something particularly unique in terms of the configuration of the technology, what you're doing, market segments that you've proven you can go at, vertical market segments. We're seeing some very, very, very high valuations in that space, mostly based on the idea that there's growth, and mostly based on the idea that those images, and particularly with AI and some of the other stuff bundled with it, can add a lot of value. In other words, it's not just providing intrusion, documentation, or protection, but you can also do various things to help businesses with their processes and other things that they may want to use those cameras for. So if you can dial that in right, I think that's probably the one area where there is the highest potential for valuation. But a cautionary note on that: a lot of the video monitoring that we've seen out there is priced in a way where the margins are relatively low, which again is fine as long as you can show low attrition rates and low creation costs. But we're seeing too many players where that's not the case. And so when somebody comes and looks at it and they're inclined to think that it's worth a lot, they quickly find out that the fundamental economics maybe aren't that attractive. And unless you can grow it at 40 or 50% a year, then you're going to have a tougher time getting that premium valuation. So probably a little longer answer there. It's easier for me to answer the question if I can talk to what you're looking at and saying, would this be particularly attractive? I can ask some questions and I could give you maybe a better answer. Which again, I'm happy to take questions after this. Email me. I'll be happy to get back to you.
I do have a few questions that I will email you, Michael, and then if you can answer them, I'll make sure they get to the people that we're asking them. But thank you so much. Your intelligence on all of this is profound, and we appreciate you attending and giving us your insight year after year. It's much appreciated.
Thank you. It's my pleasure. Thanks for inviting me.
Thank you. Okay, we are going to now move on to, I wasn't ready yet, but okay.
Go ahead.
Did you mute?
I'm muted.
Okay, we're moving on to our best business practices panel with Mark Osborne as the lead, and I will give it over to Mark now.
Thank you so much, Melanie. Please excuse the little echo that we have. We're sitting, what, 3 feet away from one another, so created a little technical difficulty. So once again, thank you, Michael Barnes, for your presentation. Fantastic, enlightening as always. A lot of great information. And so Melanie, I want to share my screen real quick. Okay. Get this pulled up. So while I'm doing that, just kind of for those of you who are new on the call, who haven't attended maybe a Live and Learn and don't know much about our best business practices and how that comes about, every year we have our dealers submit their top challenges within the industry or what they see that those are going to be for the year. We put those in a list, and then at our residential summit, or this year there'll also be a commercial summit, we have the dealers vote in small groups on the ones that they think are the most relevant. So we have calls leading up to the summit, and then we have focus groups that get together to try to answer some of these challenges. So it's been very interesting to see how that comes about and how that, and I can tell you the conversation that we've had has gone several different directions. And the first thing that I want to do is make sure that I introduce our panel. If I can get this to move ahead. There we go. So first of all, I'd like to introduce from Tampa, Florida, Mr. Guy Ross from Synergy. Guy, thank you so much for being on the call. Yeah, and Stan wanted me to make sure that I mentioned holder of the Lombardi Trophy. So probably because of that jersey you were wearing. And then from Raleigh, North Carolina, we have Mr. Ralph Gregory from Security Force. Losing the mask. Good to see you, Ralph. From Greenville, South Carolina, we have Mr. Greg Ross from On Duty, South Carolina. Greg, thank you so much for your time. And then, of course, we have from Ormond Beach. If I said that correctly, I was corrected. I keep saying it wrong. We have Mr. Ali Babazeta from Habitech Systems. So, Ali, thank you so much for joining us today. So the two topics that we decided on as a group when we started doing this last spring sometime were alternate forms of revenue and then maximizing RMR. And that was actually moved on to maximizing RMR in the production builder space. But I can tell you some of the things that we're going to talk about today. It's just amazing when these, when you, the dealers, get together and start comparing notes about how you do things, the different directions that conversation went in. So the first thing we're going to talk about today is some alternate revenue sources, being solar, outdoor shades, outdoor entertainment, some air filtration. Two things that COVID brought about that would not have existed prior to COVID are air filtration and mass detection. So with that, I'm going to start out with Mr. Ali Babazeta from Habitech. I know you guys are doing solar and outdoor shades, predominantly outdoor shades. And just kind of wanted to get your take on how long have you guys offered this product and what prompted you to get into that market?
Okay. As far as solar is concerned.
Maybe on mute, Ali.
No. Can you hear me? Can you hear me? No?
I got you now. Yes, sir. Thank you.
Okay, sorry. As far as solar is concerned, we've been doing it for about 10 years. We actually don't do the work. We just sell, and we've teamed up with a local provider, and they take it from there. Okay, so we just connect them. Actually, we provide them the lead, and then they take it from there, and we get a commission if they sell. That's all. As far as outdoor screens are concerned, I would say about 1.5 years right now. And so it goes very well with what we do inside the house, automated shades. Sorry, I have a little cold today. And has been a great compliment. Especially in Florida, you can enclose the patios and whatnot, and people really like it. It's has really high margin still, and you can connect it to your automation systems. So that was a good synergy for us, good match.
Okay, and this came about as an extension of your shade division, correct?
Correct. We started by just doing shades inside, automated shades, Q motion and whatnot, and then we got into this market.
Okay, fantastic. And moving on to the outdoor entertainment portion, I know, Guy, you guys do quite a few things when it comes to outdoor. I know that as far as outdoor entertainment's one of those, but then there's several things that you guys offer through your builder clients. So would you mind expounding on that just a little bit and kind of describe the different options that you offer?
Sure. Can you hear me okay?
Yeah, we got you now. Thank you, sir. We got you.
Can you hear me okay?
Yes, sir. I can hear you. Can you hear us?
There we go. How's that?
Perfect. We got you.
Okay, thank you. Sorry about that.
That's all right. Thank you.
I had to click a couple buttons there. Yeah, on the outdoor entertainment. In addition to the standard things, I know most of us do outdoor lighting, outdoor audio, and things of that nature. We've progressed from there and kind of thrown in outdoor kitchens and gone a whole different area. In Florida, due to the weather and the reasons people come here to enjoy the outdoors. We've gotten encompassed in what you show on there. Outdoor pergolas, pavers, outdoor kitchens, fireplaces, fire pits, water features, things of that nature. So, it was a big step for us, and I know it's really out there in left field for a lot of people. But if you have the weather, you have the people coming. I mean, it's really, especially the pandemic. I mean, this is a vision that we had a couple of years ago, and when we stepped into it with the help of the pandemic, now people staying home more, not going out. They're investing, as we all know, in different aspects. So they're investing in their outdoor living and increasing that area and what have you. So we've really gotten up on the bandwagon and seen tremendous growth. But we've also obviously the outdoor lighting, landscape lighting, landscape audio. That's how we kind of got into this. We want to kind of offer a full service package to the customer instead of having multiple trades and multiple calls to schedule. So it's great. It's intriguing. It's inviting. It's kind of re-energized us, and it's just kind of a whole new world. But the lighting and everything is really done well, and it's taken off.
So how did you guys create awareness that you offer some of these non-traditional things? I mean, is this different packages that you're offering through builders?
It is, yeah. Probably I'd say about 40-50% of our builders got on board. It's something they wanted to offer. They show it in their models, and you'd be surprised to see how many people are showing their models, but then they don't actually offer it. It's just to kind of dress up their models and give it that eye appeal. But then you ask about it, it's like, oh, they don't really sell that. We don't partner with anybody. So we found that to be a much easier way to open up the doors in order to build it, in order to do business with them. So we kind of lead in with the outdoor living, and then we try the low voltage as well. But we have it in our showroom. We brought in many displays, rock walls, fire features, electric fire features, kitchens, and what have you. So we do about 90% of our builders, we do our option meetings in-house. And so as they come through our showroom, they see that, and we don't have to sell it. I mean, it speaks for itself. So if they're interested, they start asking questions, and it just kind of goes from there. But we do have it in all of our showrooms. And of course, we hired a separate marketing company. We have a separate website. So though it's still under the Synergy umbrella, we do market it differently, and we have a marketing company that does the blogging on the social media and what have you, kind of create awareness. Synergy's been around a long time, so our company does well on the low voltage side with a name recognition. But those outdoor kitchens, we got to create that. As you said, we got to create that knowledge of what we do. So.
Fantastic. That's exciting. Now, so your sales reps, are they doing the design of that as well, pricing it out, and then the installation is subbed out?
Yeah, we put together some packages and some easy buttons, so to speak. So we've got a 5-foot straight, a 7-foot straight, a 9, an 8x8L, things of that nature. So we've got preset packages that all you do is click a button, and it automatically brings in the entire assembly that shows what size grill you're getting and what the components are made of and what encompasses the option. So we put some easy buttons together, but then again, we have some more custom builders that don't mind you going off menu, so to speak, and creating more of a custom environment. And so with that being said, we have a full-time project manager. He then will sit with the sales guy, get the dimensions, the wants and desires of the customer. And then we just start designing it from there, and we'll customize it and put it on a Visio layout so you can see what it'll look like and place it right on their patio, so to speak. So.
Fantastic. Thank you very much. And I've noticed on a lot of showrooms that this particular look is showing up. So I think there's a couple of folks putting their toes in that. So thank you very much for the information.
Yeah. Absolutely.
All right, so here's one that kind of took me by surprise as we were going through talking about different things that folks are doing since COVID came out. So we've got Mr. Ralph Gregory down in Raleigh, who is doing an air filtration system, marketing that. And so Ralph, I guess, first of all, how did this come about? I mean, how did you come across this product or create awareness that you're doing this type of work?
So a good friend of mine in Arizona actually told me about it and what kind of success they were having. And, so we decided that we would give it a shot, take a look at it, and then see if we could present it to our existing customer base and then our go forward customer base. And we've met some great success with it. Obviously, sales picked up in 2020 because there was some concerns about clean air and what this thing can actually provide. And interesting technology used for astronauts is what it was designed for. But it uses light waves as a catalyst, and it processes the scrubber ions throughout the ductwork and then to every corner, and then effectively treating and purifying your space. So when you look at that, it's called active pure technology. People are very interested in that, and it helps with folks that have allergies and asthmas, kills on contact on surfaces, up to about 99% effective. So that's why we decided to give it a shot, and it kind of tied into what we were doing. So.
Okay, so you originally reached out to your existing customer base to create awareness, and now you've added that on to new sales as well?
Yes.
And what is the installation process? What's involved in putting one of these in?
So you need a good saw, round saw, cut into the ductwork, and obviously most air handlers, where we're at, has some type of AC supply close by so that we can plug into. This does require electricity. So you plug into it, and it just inserts into the duct, and when the air handler comes on, it filters through this air filter purification system and then into the house.
All righty, and actually we've had a question come in for you, Ralph. Let's see, so how does this not become part of the HVAC offerings and production builders? Is this a builder play at all?
Well, we're offering it through the builder channel currently, and as far as HVAC system, them and what they do, I don't really know. Maybe they're not in tune to offering this product, but we certainly are, and we're taking advantage of it.
What the brand is.
Okay, yeah, we'll send all of that out at the end of the call. All right, Ralph, thank you very much. Appreciate your input there. It's pretty exciting, and I saw one of your marketing pieces that came out. It's a pretty good margin on that, it looks like.
It is.
All right, and so you guys, now you and I have I've been in your office, also on the phone. I noticed that you have worked a lot with these temp scan mass detection opportunities. And so I know this is a very big thing. Everybody's been pushing it. Everybody in the world has some kind of temp thermal scan. But what I wanted to ask you about is, where are you finding the customers? How did you go to market with this? Because I know you're having quite a bit of success with it.
Yeah, and interestingly enough, this speaks to the strength of AIN, in my opinion. But Dwight Sears actually turned me onto this, and from what I understand, Rusty Howard turned him onto it. And Dwight, my first question to him was, man, how do you sell that? And then his response to me was, how do you not? So we started offering it, attacking school systems, banks, office buildings, CPAs, attorneys' offices, real estate offices, doctors' offices. All those are targets for this. Just had an order go out for in Lansing, Michigan, for 15 units in a school system, and we did the first 15, and there looks like there's 85 in the balance on that. Did a couple of school systems here in North Carolina, CPA firm in New York City. So real simple to install actually on the kiosk itself, and it gives you a two-prong approach. It stores up to 10,000 images, gives you your temperature, and then lets you know if you got your mask on or not. And it hooks up to a software system that someone at the desk, an administrator, can manage. And it does have an access control piece as well with it, but we have not utilized that piece of it at all.
Fantastic. Well, thank you very much for the information. And just so the group knows, there's multiple manufacturers, several that are in the group that have this technology available. And then of course, Ralph will make himself available as well if you have additional questions on that.
Great
So
margin.
Ralph, anything else you want to add on that one?
Great margin.
Great margin. Everybody loves to hear that. Great margin. All right. Thank you, sir. Appreciate your input. So moving on to maximizing RMR. Like I said, this conversation went in several different directions. It was very interesting and very enlightening as we went through this. And I'll tell you, during the summit, this was maximizing RMR with production builders. What was determined is that nobody has the magic bullet there. That market is becoming tougher and tougher to get access to the customer, to convert monitoring agreements. But as we went through this conversation about, one of the directions that we wanted to go, what came out of the summit was that we had some success with folks using technicians as their salesperson. So we were going to work kind of on a manual or a how-to or a training on that. But as we went through this, it went in so many different directions that it was kind of interesting to see where technicians are utilized and some of the different things that are being marketed out there to increase RMR. So we had a survey here that actually we're having a little bit of technical difficulty. So I'll ask it verbally, and then we'll find out, is that, do your technicians have the ability to book additional equipment or an RMR job while they're on site? Can they do that seamlessly from the job? Because Michael Barnes was just talking about the technology that's involved. And I think, we live in an Amazon world. People want to move quick. They want it that fast. Manual processes are frowned upon. And let's face it, we're in the technology business. It's what we do. So if that's not the case, would encourage you to do so. But then there's still other efficiencies that can be put in place for that. So one of the things I wanted to run down real quick is that, what are the existing customer opportunities? We figured out that there are two different ways to create RMR. All right, one is your existing customer base. The second is bringing on new business. So between service appointments, your 3G upgrade opportunities, conversions, which I think are a huge opportunity. Michael Barnes just talked about some of the aging systems that are out there, which most of those are not on automation. Great opportunities. Referrals through existing customers during this process. And then, of course, warranties and service plans came up in the middle of that. There are some folks doing some things out of the box there. So the first thing I wanted to do was Mr. Bob Azeda, as we went through this, he's outlined a process of some things that they have done. And I think it was either a service call or 3G conversion, where he had somebody on site. And Ali, I'm not going to tell the whole thing for you, but I know that you guys have seen some significant opportunities resulting in quite a bit of revenue from service and 3G upgrades. So I'll let you take it from there.
Sorry. Basically, when technicians are on site to do a service call or an upgrade, they look at the customer's equipment, and many of our installs are 5, 7, 10-year-old. And so they suggest an upgrade. They said, would you be interested if I propose an upgrade, upgrade your system, let's say a Control 4 system or an ELAN system or whatnot. And then, most of my technicians, they can do an on-job sales really well. I mean, they connect with the customer. Customers have confidence in them. So they typically say, okay, give me a few days and then I can come back with a proposal to you. So they typically come back to the office. They work with a sales guy, internal sales guy. They kind of come up with we have some kind of a commission sharing plan for that kind of jobs. And then they work together, and typically not the sales guy, but that service technician will present the proposal to them so that the customer feels it's coming from the technical side rather than the sales side.
Mm-hmm.
And we've done many, many big jobs, updating their control force systems or audio video systems, obviously security also with that type of system.
Yep. And so the two-step process of getting involved with the salesperson, obviously to create the proposal and then going back and the technician presenting that, I'm assuming that's on larger control jobs, correct?
Correct.
Okay. And so give us an example of a success story. I mean, what's the biggest turnaround you think you've had on one of those?
I mean, just 2-3 weeks ago, we had a customer had a control force system installed about 11 years ago. A doctor, I mean, he upgraded the entire system. He signed up for about, I think, was 28,000. So the technician who went for a service call for some issue that he had with his control force system, and I think he started 2 days ago. The install actually. So that was a very recent success. And by the way, if it's a minor, they also, all our techs, they have a list of approved product that they can sell on the job site. A quick, for instance, like a Sonos type of deal or Clips type of deal, speakers, a lot of security system upgrade that they can do right then and there. So they do it right then and there without making another appointment and all that stuff. And they get paid commissions on those as well.
Okay,
and lastly, if they go for a security turn on, non-monitored, because we tell our builders that we can go, if the customer doesn't elect to be monitored, we still go there and do a turn on, show them their system and all that stuff. If they get a contract from that customer, they get paid a good commission as well.
Fantastic. And that was my next question on some of those, because I actually worked with with Danny on your internal team there, and you guys carry a very nice kit of things that could be upsold easily for every for every install, every service appointment. And you have the ability to add RMR on there. That's fantastic. So for the sake of time,
we actually have a name for it. We call it STUB, Service Technician Upgrade Box. So it's a virtual box, but they're allowed to sell from this box.
The STUB box. That is awesome. That is awesome. Thank you, sir.
All right, no problem. Thanks.
All right. So for the sake of time, I'm going to run through the rest of these. I mean, obviously, conversion opportunities huge on the existing side, especially for retention. Referrals through the existing customer base. Every time they're on a 3G upgrade service call, having the opportunity to say, hey, if you've been happy with what we do, who could benefit from the services? And then also two, warranties and service plans. Guy missing that. I know you guys are doing some things now with 3 different tiers of warranties and service plans. And I've heard through COVID, I've heard some great success stories on the monthly service plans with folks who have to have their network up and running all the time. I mean, some of these dollars that are coming out of that are absolutely crazy. So I'm going to move on to maximizing RMR with new customers. And like I said, this came about by talking about how we were doing that through builders. And I really wanted to zero in on some builders. But before I do that, throughout all of the conversations that we've had on our calls, I know, Guy, you guys at Synergy, there are some things that you do and have done for years and do it probably fantastically, do it very well. I know your focus was on RMR, and you made a couple of changes there in order to kind of see that turn a little bit. So you wouldn't mind expounding on that just a little as far as some of the things that you guys did on your end with your reps from a comp standpoint.
Well, it's be honest with you, it's like Ralph had said earlier, we do the networking that we do on a monthly basis with some of the other AIM dealers and finding out that, we thought we were doing okay until you start comparing numbers to some of the other AIM members and think, we're not doing things quite right. So yeah, we started changing a lot of our processes. We meet with a lot of customers and options through our builder program, and we were really remiss in the fact of trying to get that monitoring signed at time of option meeting. And we're fighting everybody else down the road, even though we call them a couple weeks prior to closing, it'd be a tough game. So now we're just increased our our offerings there, and we're selling more activations. We're spiffing them, not just the commission that they'd normally get, but we're going above and beyond to spiffing them because, we're not having to get so competitive down the road. The longer that takes for you to get that minor agreement signed, the more people you're having to challenge and come up against. So we find if we give them a spiff, it kind of incentivizes them to get that agreement signed earlier, and we can invest that extra money into our team as opposed to having to lower prices or give away product because now we're having to go against the other competitors. So that was the biggest change that we made, is really going that way. In addition to all the warranties, obviously the service plans, the warranties, packaging, what have you, we really stepped that up and have seen good returns on that. But we were in this for a number of years, but being turned around.
That's fantastic. That is awesome. So, and from what I understand, correct me if I'm wrong, is that, the guys that, doing the large custom jobs are very good at converting extra equipment and all that. Is that a portion now of their, how their comp is based on converting monitoring agreements as well? Is that correct?
Absolutely. Yeah, our conversion rate we're doing pretty well on all our customer jobs, but we get so tied up in the beginning of it and doing the option meetings, what have you, we're just following through. So again, we just started a structure that allowed them, the more accounts they were able to sign, the more custom jobs they were able to convert to RMR, then they would get incentivized and get larger commissions to kind of drive that. So it's not just the same, you sell 3, you sell 4, you sell 5, the same commissions, but doing a stair-stepping method and increasing the potential of income for our sales team as well as our technicians as well. As Natalie had stated, you have to be prepared. Everybody in the organization has to have a sales hat on at some point in time or another. Your schedulers, we've got a program put in place for our service schedulers that they're incentivized very well for upselling. And that's been an increase, as well as the technicians out in the field being able to sell on site, get the signature, collect the payment, install it, and do everything right then. Like you said, we're in the tech business, and we can't go back and do quotes and schedule to come back out. You got to strike while the iron's hot, and we're on site. Technicians are in a perfect position to upsell the customers and offer them new conveniences and different things. So
exactly right. There's just a different trust level there.
No question. Absolutely.
So thank you, Guy. I appreciate that. So moving on here, I wanted to get into kind of how this whole conversation started as far as converting builders. We've got Mr. Greg Ross on from Home Duty, South Carolina. And Greg, glad you could join us today. And I'll put a couple of points up here just as a reminder of kind of what we're seeing out there. And I know, Greg, that you had a builder who had made some changes, and without telling the whole story, I'll let you go into that and kind of talk about some of the ways you combated that to increase your close rate there.
Sure. You can hear me?
I can.
Good. Okay. Yeah. So we took a long-time builder that we had that was looking to make some changes and do some things, and we introduced them to primarily the alarm.com builder program, and so we started installing a basic home automation system through a wireless alarm system, of course. And, at that time, we didn't know exactly how it was going to go, but we started putting these in closer to closing. There's no rough in, there's no internal, original meeting. We don't have hands on the customer early in the process. And then it kind of grew into, we figured out that our technicians are highly likely to run into these customers because they're putting these systems in just days before closing. And so they've started running into them. They've started learning to leave their numbers behind. And they essentially turned into our salespeople. They're converting these things on site. So we had to go back and come up with a comp plan for them to incentivize them to do that. And it's been real successful. We've had really good luck with it. And, we're still developing our training program with them to teach them how to upsell and, get out and maximize that opportunity. But it's been kind of a 50-50 split. The guys that are out interacting with them, half of them are really encouraged about making more money and they're excited about it. And the other half, not so much. So it's been, it's been kind of interesting to see the response from the technicians, because they've always had the ability to sell and they've always had the ability to make a little extra money. But now they're really making significant money when they're, closing 2 or 3 of these deals a week.
Yeah, that's fantastic. And what it does for your bottom line is incredible. But that's the next question I wanted to ask was, what training did you provide? The ones that really latched onto it and did well, but what kind of training did you provide them or coaching?
Yeah, well, in the beginning, we really did this poorly because we just didn't realize that they were going to be the face of this. You know, we were printing material, we're putting stuff in closing, we're waiting to talk to the customers, and then we find out that these guys met them days before, and they know exactly who the client was. So we've since went back and sat down with our salespeople, and again, we got a little bit of a mixed review there as well because the salespeople were not as anxious to teach. But we've come up with a plan to teach them how to, you know, make sure they're leaving their number, make sure they're talking to the client and gathering their information, because that was the biggest thing, is we weren't getting the information from the builder, but we find out that the sales, you know, the technicians have already met these clients. So we've come up with a little 10-step process for them on what to do and what, you know, to get that information back. And, you know, again, some of these guys are turning this into the office and walking away from it. And the other guys are really capitalizing on it. They're coming in to the office and asking for, you know, because we're using the alarm.com program, we've got a ready-made list of houses that haven't been converted yet. And they're going back and, you know, knocking on doors.
That is fantastic. And so from a compensation standpoint, you said it's made a huge difference in their pay. How did you structure that? Yeah,
I mean, absolutely. What we've done, because the system's paid for by the builder, we've got nothing going in. We're charging a $99 setup fee, kind of like the old ADT models. And these guys are getting $200 every time they close one. So they're really excited about it. We're looking at that again to go back and possibly do a no contract type thing, and that's going to affect some of that. But right now they're signing an agreement, and the guys are getting $200 compensation every time they sign one up.
Fantastic. That's awesome. Thanks so much for sharing that. Appreciate it. All right. So that leads me right into the next piece, and we're going to have Mr. Ralph Gregory talk for just a minute. And I put the thing up here that maximizing RMR, the sales rep is not who you think. All right. I had another question here that I was going to put up that, and I confirmed this from some of my previous colleagues that, you know, some of the, won't mention them by name, Michael Barnes did, but I won't mention them by name, but what percentage of sales do you think are made in this industry? And I'm not talking about DIY. I'm talking about security systems where they show up, put it in, what percentage are sold over the phone or through e-commerce? And I was able to verify this by some of my older colleagues, and that is 85%. 85%. That is huge. So that'll tell you, Michael Barnes talked about some of the advances that some of the big guys have made, and a lot of that has to do with digital. And so one of our dealers has been doing this for quite a while. It's his model. So that means that a lot of times the technician is the first face that this person sees. Because what you want to do is try to secure the transaction as fast as possible, get it off the street, and then in a simple package. And you know what? I'm going too far, Ralph. So I know this has been your model for quite a while. So if you would kind of walk us through your process.
So for us, we sell it over the phone. You know, we have an opener and a closer. You know, and then what we do from there is we send it to dispatch. From dispatch, we send out our director of first impressions, which is our technician.
Yep.
The technician is the first person they're ever going to meet. So if he's having a good day, the company's going to have a good day. So our technicians are nothing more than sales guys with iPads. It used to be tool belts, but it's more like an iPad now because everything is so electronic and for the customer. So for us, it's a real simple math formula. You know, we want to see from dispatch to installation 80%. We know that there's going to be buyer's remorse. There's going to be third-party interference. There's going to be things that happen overnight. We don't have a backlog in terms of installations. We try to install these within 48 to 72 hours. And technicians are excited to get out there for the opportunities.
Fantastic. So next question. So obviously that's an entirely different skill set when you're looking for a technician. So, I mean, what are you guys looking for when you recruit to bring in new personnel?
Not a technician.
Got it.
So, you know, our best guys came from the restaurant industry, from the, you know, had a couple of used car sales guys. Anybody that's personable, can look you in the eye, can speak to a customer. We can teach them how to run one wire. Not that difficult to, you know, place the panel above an outlet and drop the wire inside the wall. So that's what we look for. We look for someone that's personable, clean, doesn't mind rejection, because you are going to get some rejection, and is you know, able to talk or speak, you know, to a customer.
Absolutely. Well, thank you very much. So for the sake of time, I'm going to move along. I can't thank, like I said, I can't thank you guys enough for taking time out of your day, for the calls, for everything. It takes a big commitment to do this kind of thing. So thank you very much. And a couple of the stats that I put on here: 41% of millennials. We found this out from Tim Costello last week, and for last month. And there's a couple of things that fit right into this presentation that we were working on. I mean, 40% of millennials, they bought a home without ever walking through it. So most purchases, how do you think they're going to make that? And those are the folks that have money now. So we're going to have to adapt to the way that they shop and in e-commerce. So I wanted to go through a few things here on the takeaways through our conversations that kind of came about. Number one, obviously attrition is still the number one priority when it comes to increasing RMR. Sometimes if your attrition is too high, you can't outsell it. So providing a world-class customer experience, making sure that you know, that everybody's happy. I had a survey question here, which I can't put up, but I will. If you guys want to email me directly, would love it. One of the things that Mr. Ross mentioned, Guy Ross, and I think it was a fantastic idea, is that a new networking group or a committee, so to speak, within the group would be an attrition networking call. And I would love to lead that up. So if you are interested in participating in that, please shoot me an email. Otherwise, I'll reach out to some folks directly. Takeaway number two, you know, we are in adopting a digital strategy. Clearly define the process. So when you receive that phone call or an inquiry on your website, how can you capture the transaction as fast as possible and get it off of the street as fast as possible? Because that's what that's where the industry is going, whether we like it or not. I mean, obviously, it would be nice to sit down, have a consultative process, but I think those days have changed just a little bit in the way people shop. So I think in our industry as a whole, you know, we've got some hurdles to get over to make sure that we're in the digital age. And so once again, this is straight from Tim Costello last week. There is no digital strategy, just strategy in the digital world. That's kind of where we live and what happens, even from a builder perspective, you know, to allow them to go in and choose what they want. Obviously, the race to stay relevant, changes in the market and buying habits, and then also changes in the builder space with access to the customer. We've got to find new creative ways to do that. If we have their attention through a website, through anything, we have to make it easy for them to buy immediately. And a lot of that's going to be digitally. And that's going to mean that the first face they see, like I said, is the technician. The technician is the one that's going to deliver the message, provide the consultation, do the upsell, and still not a DIY product, not a fan of that, but I think that's where we'll see a lot of this go. So from a technician standpoint, obviously provide basic sales training, require your sales manager to attend tech meetings, you know, have him sit in and provide a few pointers, ensure that he is available as needed when the tech is on site. And I can tell you from from my experience, provide an incentive for the sales manager, because just like Greg said, some of your sales folks are not going to be happy that the technician is involved in this process, because they see that as a lead going away from them. And so the sales manager obviously needs to be compensated to make sure that your overhead is less when this happens, that they are available and assist when someone is on site and needs help with that sales process. Takeaway number 5, this is the Ralph Gregory slide for me. What's in it for me? You know, that's what the tech wants to know. What is in it for the tech? And at the bottom line there is a higher income, more money, without a doubt. I mean, obviously it's a different skill set. They have to evolve. There's going to be pushback all the way around, but it's more money in their pocket, which of course for you guys helps on the employee attrition side. And so what is in it for you as the dealer? Number one, it allows your salespeople to hunt for what you weren't going to get anyway. If you made that phone ring, you spent money to do that. If they're on your website, you spent marketing money to do that. Allow customers to buy on your marketing dime, and salespeople to go out and find the things that you wouldn't normally get. Obviously, it's going to increase your efficiency. And one of the things that I have noticed in my experience as well is that a technician who learns to sell and gets used to making that money, his interaction with the customer changes his attitude. And 100% of the time, I've never seen this not be the case. His rework and the quality of his work goes up every time without fail, just because of the engagement that it takes in order to do that. So we're going to open it up to any questions that come through for any one of our panelists. If anyone has any questions, please send those through on the chat or the Q&A.
I see AJ asking, what are the tech selling extra? I'm not sure at what point that came in.
So what are the tech selling extra? So Ollie, you want to talk about that from your what is it? Your swag box?
Yeah, I mean, we do like Bluetooth speakers, Sonos, clips, all security basic elements, wireless, like if it's a alarm.com system, alarm.com image sensor or cameras, basic remotes, like a Harmony style where it can be installed easily. I'm talking about the stuff that can be installed easily. And then WAPs, UPS, Wattbox, Roku, Harmony Pro Logic, Harmony Pro, subwoofer, that kind of stuff. That's are very easy and to install. If they see there's an opportunity there with the customer, that's basically 80% of the stuff we sell.
Fantastic. And then also too, I remember from putting that box together, there's some security by smoke detectors, that kind of those things.
Yeah, exactly.
Recommendations.
Security system stuff. Yes.
Okay.
Someone asked, who is the spiff going to?
Who is the spiff going to? I'm not sure what they mean and which context. So is that if the salesperson sold something, or if the technician sold something? Yeah, it's hard to tell in that context.
I have another question.
Yeah, I mean,
on your alarm contracts, what is a typical contract amount in term agreement?
So
for me,
what is your, Ralph, I'll ask you that since you're the one that's doing most of it. It's kind of streamlined there. What is your average?
Typical contract amount in term agreement.
Typical contract amount in term agreement.
Well, through our partner in the group there, Ain Ally, we utilize the purchase conversion. So our typical RMR for there is somewhere around $29.95, and the length of that agreement is 1 year.
Okay, and then of course that's fully funded on your side as well.
It's fully funded from the consumer taking the debt where it belongs.
Exactly. So the debt stays with the consumer. So it's typically, the ADT Vivint model, no money down, financed through the consumer.
For the sake of time, we've got one more question. Do they value delivery, programming, setup tech?
The tech, do they say that again?
Do they value delivery, programming, setup?
Delivery, programming, setup. I guess the question is, from a technical perspective, are they fairly technical folks that are able to deliver that at a quality level?
Does the customer value those services?
Oh, does the customer value those services? Sorry. So anybody want to take that one? Okay, we'll send that out to the group and get back to you. So for the sake of time, that's going to be our last question. I wanted to thank our panelists. So Ralph, Guy, Greg, Ollie, thank you so much for your time. Cannot thank you enough for helping us out. And if you have any questions at all, please email me directly, or you can send it through the chat, and I will be more than happy to answer those directly. So with that, can't thank you, the audience out there, enough for your time and the opportunity. And with that, I will hand it back to Mel.
Okay. Thank you, Mark. Just as a reminder, can you turn that down, Mark? Yours down. April 7th is our next BBP and our next virtual conference. And in the BBP, we will be talking about builder education and the 3G CDMA sunset. Then we have one May 5th and again on June 2nd. So thank you for those who have hung in there with us for today's virtual conference. We're almost completed. I just want to turn it over to Mr. John Begney to explain what this month's special is in the marketing department.
Thank you, Mel. Thank you, Mark, and thank you, AI and dealers, for joining us. Just on a side note, before I talk about, what we've been doing over the last 3 Live and Learn conferences is trying to put out an offer on a marketing SKU that seems to be drawing some attention. And again, as another sidebar, just so everyone knows, we are working very diligently with the partners. In fact, there's a forum coming up tomorrow where we are hoping to roll out some more serious digital marketing SKUs come into summer here. So I hope you can hold on for that. Now, the marketing SKU you're seeing on the screen here, the reason we chose these static cling labels, come in any size, shape, message, is we're seeing pretty good pull through from the dealers on leaving these in the home with offers. This one here, the doorbell with monitoring offer, one of our integrators was using this in the home, putting it on the structured wiring cabinet. And they saw at one point an uptick of 40% of inbound phone calls from homeowners that they didn't get to meet with. Other dealers are now installing these stickers for various offers. For example, covering up a television outlet plug that I believe the offer is hang 2 TVs, get 1 free. They're seeing action on that as well. So, don't forget about doing some sort of a little in-the-house marketing. They're very affordable. They can be down as low as 15 cents a piece. Again, that's a great price to maybe get a phone to ring. And, we can do larger ones. In fact, we just did one last week for a client that darn near covered the whole center of the structured wiring cabinet. List of services, logos, name it, it was on there. So keep that in mind. And up until the end of this month, they're 25% off. So without further ado, we'll let us move on. Thank you.
Thank you, John. Okay, we've made it to the funnest part of the virtual conference. We are moving on to our giveaways. Oh, what am I doing here? Sorry about that. Getting a little squirrely. So today we have Annixter, HP, Maxwell, and Digital Watchdog all giving away something. I'm going to turn it over to Mr. Scott Kreider to tell you about Annixter, and then we'll do the drawing.
Hello, everyone. Thanks for making it to the 3rd of our Live and Learn conferences. We appreciate everybody for attending. I've said it on the first 2. I manage the AIN relationship within the Annixter world, and really enjoying doing that and trying to work towards making you guys be all better and make us all be stronger together. Just to touch base on a couple of things, I've stressed it on each one of the calls we've been on, a total dedication to the AV space that we have now. We've got product flowing into our branches to help support your needs there. So please let us help you out there where we can. One other thing that I wanted to touch base on as well, and this is the power of Wesco and our merger together, is a technology services group that's coming together that will be there for all of us to use going forward. Don't have a time frame for when it will be live, but it's going to be something of a support nature where not only I can call in and ask questions for you and be able to help you better, but hopefully you guys will be able to reach out as well and use that branch of our organization to help better serve you and get answers to some of the questions that you have. So I only have a couple of minutes. So I wanted to touch base on those 2 things. And then I also wanted to go along with our little giveaway and ask another trivia question. I did that last month, and I'm going to do it each month. We're in March right now, so that brings us to, for those of us that are sports fans, a little bit of March Madness time. So I've got a question. I don't care how you answer it, whether you respond in the chat, whether you come to me in a text or whatever, if you have my digits. But here's the question. Who was the last college freshman to be a one and done and win the NCAA championship? And who did he play for? Last college freshman that won the NCAA championship as a one and done. And what school did he go to? So there's the question. Mel, you can go ahead and give away the package. And,
Okay.
and Kevin Santelli just answered the question properly. So Kevin, I will be reaching out to you.
Okay, we are spinning for the win of the Ring doorbell from Annixter. And our winner is dun 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 dun. Neil Atha. Congratulations, Neil. We'll reach out to you to get your shipping address, but congratulations on that. Next, we are going to HP. I don't know if Amy's on here. We might just do the roll. Amy, are you on? Scott, someone's asking who was the one and done. Did you want to?
It was, I'm sorry, I apologize. I should have told the answer. It was Carmelo Anthony from Syracuse. That was a long time ago. It's amazing that it's been that long since a freshman one and done won a championship. But yeah, that's the answer. Carmelo Anthony, Syracuse.
Okay, we're moving on to HP. I don't see Amy. Wesley.
She says she's on. She says she's on. I just see her responding.
Tell her to come next door into our room to do her commercial part, if you can. Otherwise, I don't. She's in the regular panelist. I can't go and grab her from there. Diane, you want to see if you can? Can you promote her to a panelist? Want to just do the giveaway and she can come in at the end if she makes it to the room.
Yeah,
okay, we're going to move on to Maxwell. And I know I saw Mr. Kagan on here. Michael, are you still with us?
I am. I'm having difficulty with my video.
Well, we can hear you. So if you want to go ahead, let me see if I can help you out with that. No, I don't see. Go ahead. Everyone can hear you.
Okay. Well, welcome to everybody. Good afternoon. Many thanks to all of you at AIN who have put on such a great show. There we go.
There you go. We see you.
Yeah. A great webinar. Thanks for doing this. And many thanks to all of our loyal customers and to everyone who's tuned in today. I know you all have a busy schedule, so I will be brief. For those of you who are new to Maxwell, we started in the security industry as a manufacturer of alarm screens in 1977. Soon thereafter, we started manufacturing alarm signs for the security industry, and now we're one of the largest manufacturers of custom printed signs and decals. With over 40 years of experience, we know what works and what can help you grow your brand and grow your business. So briefly, here are some of the benefits of working with us. We offer the largest selection of materials, including styrene, polyethylene, aluminum, PVC, all in reflective and non-reflective styles, mounted to stakes, not mounted to stakes. We print single-sided, double-sided, reflective decals. We also print business card decals on low-tack vinyl, which are popular with many sales teams. This is a lot like those static cling material that John was talking about, but they're really printed on low tack vinyl with a clear materials. You can put the business card behind there and have someone be able to contact the sales guy right away. We also offer the best pricing to AIN dealers of any people out there. So that's great benefit. Artwork design is always free for all AIN dealers, and we do not charge for setup or for color matching. Our two-piece stake system is perfect if you plan to ship signs direct to your customer, either as part of a DIY kit or shipping additional signs to your customers, or maybe as part of an acquisition. We can even do the shipping for you with smaller packaging. We use USPS first class mail, which will significantly reduce your shipping cost. If you're a company that uses 1,000 signs or more, you might want to consider using our inventory program, which allows us to print our signs, keep them in stock for you over a 6 to 12 month period of time. We ship it when you need it. So not only do you get better pricing because you're purchasing a larger quantity, but you also avoid the usual lead times between orders. We also recently redesigned our website. For reorders and inventory customers, you can log into your custom portal and order your custom signs and decals anytime, 24/7. So please feel free to contact me or any of our helpful staff to discuss your needs in more detail. You can reach us at 1-800-4SCREEN. When we originally started in 1977, we started, as I said, making alarm screens, and that's where 4SCREEN came from. But it also works with screen printing. So it's 472-7336 for those that need the number. But in any event, thanks so much. I'm now going to pass it on to Melanie for our giveaway, which is a Kindle Paperwhite e-reader without any of those annoying ads. Thanks so much for your time. Look forward to seeing you at the next AIN conference.
Thank you so much, Michael. And we're going to turn to see who our lucky winner is. And the winner of the Kindle Paperwhite tablet is Ali Babazeta. Congratulations, Ali. We will be contacting you to see where we will ship that. And now, my apologies, we will move back to HP with Amy Wesley, and she's coming live from Diana's computer. I'll turn it over to you, Amy.
Am I on? Yes. Hi, everyone. Thanks for joining us for the third Live and Learn conference today. I wanted to tell you a little bit about the room track back that we're giving away today. It is a great add-on product, as Mark's segment was talking about. It's something that your techs can add on very easily and go out and sell that product as they're on service calls or installations. It's an all-in-one kit that comes with everything that you need for the installation to be surface mounted. And I'm sorry, there's a little bit of technical stuff going on in this room I'm in. It comes with everything that you need for the installation. It ships in 2 boxes. It's easy to inventory. It's easy to install. It takes about an hour for installation time. Your profits are great on it. You'll have room to provide that commission to the sales tech or to the technician that's doing the installation. So consider the product, and I'm going to thank you for your time and turn this back over to Diana to do the drawing for us.
Thank you, Amy. And for that lucky room kit, the winner is?
Nobody yet, I'm not ready.
And we're spinning. Gregory Barker. Congratulations, Gregory. We'll reach out to you to get your shipping address and make sure we get that to you. And last but not least, I will turn it over to Mr. Somerville with Digital Watchdog.
Excuse me. Good afternoon, everyone. Thanks for allowing me to participate. I enjoy the entertainment towards the
Jim,
end
we
of this.
cannot hear you if you're speaking.
Oh, no.
I can hear him.
You're still on mute, Jim. You can come right, oh,
Can you hear me now?
yes, can hear you now.
All right, great. Well, thank you, everyone, for that tail end of the entertainment. It was fun. I just want to take a moment and just kind of share a couple of comments about DW. We're a proud vendor, obviously, of the AIN group. Just as a quick summary, you know, DW's been is an American company. We've been in business since 1987. We offer a complete line of NDAA, TAA compliant products, and those range everything from HD over the coax from 2 megapixel to 4K on into our IP camera line, which ranges everywhere from 2.1 megapixel to 48 megapixel, as well as a bunch of specialty cameras, and then into our servers, which range everywhere from plug and play MVRs all the way up to 500 terabyte solutions on the enterprise level. So with that, I thought I'd just make a few product announcements because I know a lot of people on this call are familiar with this already. In the past few weeks, we've just introduced our new highly anticipated intelligent video analytic cameras. And this is high-end analytic solutions that are in fact on the edge, camera-based, if you will. That's backed up with our new Blackjack rack servers, which we've been working on for quite a period of time, and the upside to this is the Blackjack rack servers include a 5-year warranty with 24-hour on-site services. All these products that I'm talking about, plus all of our entire line, of course, is always available, and one only needs to reach out to one of our 60-plus representatives throughout the United States to support you, and I know that many of you have, so that can be a webinar, end user presentations, end user, our job site walkthroughs, end user presentations on site. We've got a team that's highly experienced and expert in all of our products. So with that, I'll turn it back over to you, Melanie.
Thank you, Jim. Do you want to tell them a little bit about what you're giving away? I know it's a camera.
Yeah,
system.
so what we're giving away today is our CAS line, which is an acronym for a camera as a system. So if you were to take, basically in a nutshell, you take the camera, you mount it on the wall, ceiling, etc. You run your coaxial cable to it. It's powered, and contained inside that camera is a full version of our Spectrum enterprise class software. So it's a serverless system. So you can deploy as many of these as many as 30 of these in a single system. And once again, no server. So you walk in the door, you mount the camera, you connect it to a network, and do a few administrative things on Spectrum software, and you're up and running. It's an incredible tool. It's very, very popular, especially with retailers, things of that nature, because it's serverless. So
Thank you so much, Jim. We're going to go ahead and spin for that now. And the lucky grand prize winner today is Scott Chitwood. Congratulations, Scott. Well, this has been a long 2 hours. I hope that it's been very beneficial. I appreciate all of you hanging in there with us all the way through. We miss you guys. We wish we could see you sooner than later, but we'll see you back here on Wednesday, April 7th. If there's anything AIN can do for any of you, please let us know. We're here to help. Have a beautiful day.